Hello to all traders and welcome to this webinar provided to you by FXPRIMUS. I hope you are doing well today wherever you are watching us from. My name is Stavros Tousios and I am the market specialist here at FXPRIMUS in Limassol. I have been trading for the past 2-3 years professionally and decided to take this a step further by entering the Forex market as a market specialist. So today we will look at how you can develop a trading edge against other traders with a good trading plan. The aim of this educational webinar is to help you improve your trading activities and may help you also improve your success chances as a trader. So please ensure you pay attention for the next 30 minutes or so. Take notes and feel free to send your questions to my email. Our webinar is called Planning to Trade, Trading to Plan for obvious reasons. If you are planning to trade, this is for you. If you already do, I believe that you also have a lot to take from this, okay? So before we see the first slides of this presentation, I would like to read out to you a risk disclaimer, okay? Please note that Forex trading and trading in other leveraged products involves a significant level of risk and is not suitable for all investors. Trading in financial instruments may result in losses as well as profits, and your losses can be greater than your initial invested capital. Before undertaking any such transactions, you should ensure that you fully understand the risks involved and seek independent advice if necessary. Any opinions, news, research, analysis, prices or other information contained on this webinar or linked to from this webinar are provided as general market commentary and do not constitute investment advice. FXPRIMUS or its representatives do not accept liability for any loss or damage, including without limitation to any loss of profit, which may arise directly or indirectly from use of or reliance on such information. Okay, so I'm going to start with this nice depiction of what having a plan means to me. Okay, having a plan means that you can increase the possibility of, you could increase the possibility of gaining more profits, okay, because you have a leverage against other traders. Don't get confused, this is the same leverage from your broker, okay? We will discuss this later on. This is what makes you different from other traders, okay? ABC. ABC is here for a simple reason, to define the importance of order and process, okay? Having a process while you trade could help you achieve your goals, okay? Now, if you include your needs to this process, what you're basically looking to achieve by trading, okay, within the next 2 to 3 years, within the next week, within the next few months, then you could increase the chances of success even more. When you have a plan and a process, you become a more responsible trader, okay? You treat trading as a business, and this is what you should do. While at the same time you become your own trader, an independent trader that makes and who is obviously able to make his own trading decisions. Okay, this could subsequently lead to a more safe trading activities and decisions. Okay, which could be the key for your trading success. Now, when you don't have a trading plan, here's what this means to me. Okay, the first thing you could come across is procrastination, which basically translates to voluntarily putting off trading tasks or certain trading activities as there is no trading process. This could lead to more losses, okay, as you are now working against your own interest, while at the same time you could start becoming more stressed about it and base your trading decisions on fear or even greed. Okay, once emotions start taking over, you could get to a point where you admit to yourself that your trading decisions are not really working out well for you. But due to the emotional pressure you experience, okay, you could start neglecting those facts and start revenge or even hope trading, hoping to get your losses back. Okay, so hope or greed in trading could transform you into a reactive trader, since the reactive and the knowledge that don't really, you know, they must come together in trading. You could remain incompetent become more scared every time you are going to hit the mouse button to open or close a trade. And finally, you could get to completely killing your trading account. Okay, this is how important a trading plan can be to your success. Okay, here some interesting statistics. Okay, you can see that actually support what I just mentioned in the previous slides. In the first study published by Wall Street Journal, I think there was around 4,000 people studied, online casino clients, okay, in order to identify how often gamblers really win. Now you may ask, what has this to do with trading? Well, we will explore this very soon, okay. For now, just keep in mind that gambling is a game of psychology. So the results the researchers found were staggering, okay. Although they identified that gamblers win only 30% of the time they wager, which is not a bad number, they also show that for every one winner, a single individual winner, okay, 128 heavy gamblers lost. That's a huge variance there, okay. The results for light gamblers weren't great either. Only 17% of them win when they wager in. The biggest winner during this study, I think it was a 10-day study period, was a Slovenian man. Okay, what he did, he's placed only a few modest bets, okay, per day. He struck the jackpot twice, and then he stopped when he suffered a very small partial setback. Wise man, okay, and it turned out well for him, of course. In the second study from Harvard MBA Business School, Harvard graduates were studied in order to assess how written and planned for goals affected their future 10 years down the line. The results showed that 13% of the graduates that had written goals made 84% more money than the ones without written goals. But the 3% of the graduate students that had a written plan, they earned 1,000 more money than the rest 97% of the class. The results also showed that 45% of Americans usually make goals, while only 46% of those make it past 6 months. 75% of those make it through the first week, and 71% of those make it past 2 weeks. Okay, so this kind of gives you an idea of how important a written trading plan is, and how important it is that you follow it consistently and with discipline over a long period of time. So let's see what a trading plan is, okay, and what is not. Of course, a trading plan is a structure for successful trading. It is a set of rules to follow in order to hit your goals. It can be used as a risk management and performance evaluation tool, as you can go back in time and check what changes you have made to it, okay, and hence check on your trading activities. A trading plan is what I like to call the golden road to success, as it helps you develop good trading habits that are very important to your success. So it's like a turn that you could take you somewhere instead of leading you to a dead end. Okay. Finally, a trading plan is your emotions' best friend because it takes away all the mental pressure as you become methodical in your trading activities. Now, what a trading plan is not. A trading plan is not a strategy. Okay. It doesn't mean that you will make money, and it certainly does not have any predicting value. However, there are many other reasons that make a trading plan trader's best tool. 3 reasons I find to be core to trading are risk management, emotions control, and goals setting. I like calling this REG, okay, as I like the sound of it when I link it with red generation. Now let's see how each one of those matters to traders, in my opinion. Okay. Risk management is not about what you can afford to lose, okay? Don't get confused. This is gambling. Risk management is about how you go about working out and executing what you can afford to lose in order to make a considerably larger gain based on your trading goals. When I say considerably larger, obviously the larger the better. For example, how much you risk to get a certain reward. If you risk $1 to make $1, this is 1-to-1 risk to reward ratio, and you would need to be right at least 50% of the time to start seeing gains. Okay, but of course this doesn't mean you can't be profitable if you're right less than 50% of the times you trade. You could just have a strategy with a risk to reward ratio better than 1-to-1. Okay, expert traders usually take trades that return more than 3 times the risk. There you go. You can be profitable when being right only 30% of the time if you use proper risk to reward ratio and an effective leverage. In the graph below, you can see the average number of pips earned and lost on 12 million trades. Okay, clearly traders lose more than what they win. Okay, for example, Euro USD traders lost an average of 127 pips to win only 65. So Euro dollar traders would need to make 65 pips on 2 trades for every lost one to break even. Okay, assuming they use the same size on each trade, of course. In case they don't, things change. The truth is that most traders don't understand or they don't look into the importance of leverage and sizing, okay? And they end up abusing it. To give you an idea, when you use a leverage of 1/100, this allows you to control 100,000 more times your account balance. When you trade in size, you use this one lot. Okay, for example, if you open an account of $1,000, you will be able to control $100,000. Okay, so leverage is twofold. You can work for your benefit because you can make, you could potentially make more when you win, but also it can work against you as you could lose more when you lose. And from what we see in the graph, it seems that the leverage is probably working against traders because of the reasons that I just mentioned. On the other hand, professional traders know how to manage risk properly. Okay, what they do is they use at least a 1-to-3 risk to reward ratio and a conservative approach to leverage and sizing, of course. So that doesn't allow them for a risk greater than 1% of their account, okay, for every single trade. They use an appropriate lot size, okay, always set take profit and stop loss levels, and they always follow the rule-based plan as it helps them with controlling their emotions. Okay, science says that there are 2 types of emotions, okay, destructive and beneficial. Destructive emotions are pretty much emotions produced by fear and greed. Fear and greed are linked to panic and euphoria, 2 emotional states every trader has experienced. Panic is well connected to having no risk management, no stop loss, for example, while euphoria is well connected to over-leveraging and over-trading, letting a winning trade, for example, pass your target price, for example. The graph in this slide illustrates very well the emotions a trader goes through, and pretty much it shows you the need for emotional balance. Okay, here's what happens in the mind of a trader in reality. This represents decisions made under emotional states that traders go through, as we saw in the previous slide. So imagine seeing the price of an instrument going up. Then you're going to start looking at the market, okay? It becomes more interesting. So if you see an increased sentiment and a further up move, you will start thinking of scenarios on when to buy, okay? Thinking that the next correction is probably the right time. Due to fear of being wrong, you could just not trigger the trade at the right time, and after a sudden spike upward, and since the price has moved further away from your more anticipated entry, you have missed the opportunity. Okay, you are now thinking, because you feel overconfident as the price actually moved towards the direction that you thought it would, right? You're now then thinking, I'll buy now as this is actually heading up. Seeing the price moving further up gives you the extra thrill. Okay, it takes you to the euphoria state of mind. And what you do when you see the next impulse wave, which is just a small down move, okay, you increase your position thinking that you can gain all the profits you have missed from your earlier delay in entering the trades. Okay, what happens now is that price moves even lower, but being so confident and sure that this is probably going to continue going up and that this is just another retest on a lower support level, you buy more. Was this a good idea? Well, now the market keeps falling and you end up losing more. Anxiety and fear take over, and when the trade is now really going against you, you start feeling depressed and panicked. So you close your position. You know what happens next. I won't go through the rest of it. I just wanted to get the point of how price, to get across the point of how price movement affects emotions and how emotions affect your trading activities. Okay, now let's look at the beneficial emotions in trading. Okay, those come from confidence and belief. Confidence is the number one feeling traders need for successful trading because it helps with regulating trading activities. In order to become more confident, okay, one needs to be committed to the strategy, to the method used, and to plan. Your expectations as a trader must be realistic and consistent, okay, so that you won't end up adding to your emotional state in case you can't achieve them. And knowledge. Knowledge is key to your confidence as a trader, as you can use it to evaluate your decisions. You just have to make sure that what you know stands true. Okay, so basically always look to learn more from reputable sources. The second component a trader can build to have better emotional control is belief. Okay, believe in your purpose and your goals, not your emotions. The three key elements I think that can help are motive, your rules, and discipline. If you have a motive, it means you have a very important reason that you trade for. Okay, so what is yours? For example, do you trade to quit your job and spend more time with family? Do you trade to become a hedge fund trader? You call it. All you got to do is simply keep this at the back of your mind. Always remember why you started trading. The second element is rules. Rules can help you increase the chances of becoming a successful trader, as when you believe in them, this could potentially limit the emotional pressure when trading. Okay, and as long as the rules are reasonable on a good strategy, then this is a win-win scenario. Now, your ability to follow those rules consistently is called discipline. Without discipline, it will be hard to believe that you can actually make it through, my friend. Okay, discipline comes in many types and sizes. Okay, for example, you can be disciplined in your daily research process. Okay, your studying of the markets, keeping a journal, following your entry and exit rules. You know, if you do this consistently, it will become a habit. Okay, it's possible. That way, you could achieve your goals, and that is why setting goals is very important. Okay, setting goals could help traders with building their confidence and belief so that they focus on the process and not on the results. Most important, what goals could do for you is help you push past your fears as they represent a tangible outcome. They represent your expectations and your aspirations as a trader, okay? Something that you're looking forward to achieve, okay? Goals can help you become the best trader you can be as they lead to progress. Progress by goal setting comes from knowledge, as your determination to achieve your goal could certainly push you towards starting the markets, okay? Which in return could motivate you even further as you know more about the markets and you're thinking that you can improve your strategy and hence your results. Lastly, short and long goals could help you eliminate past mistakes, okay, that led to big losses, as long, of course, as they are reasonable. Okay, for example, learning how to identify trends in one day compared to 1 month, or making 10% a month compared to 200 a month, okay? Or become a full-time trader when you actually have to start in your spare time first, okay? Trading goals must be able to work for you, okay? And they must be smart in order for this to happen. Setting smart goals is simply answering a few structured questions. Reasonably answer a few structured questions. By structured, I mean smart. Okay, so strategic and specific. For example, what are you looking to achieve and why? They must be measurable so that you can measure their success. They must be achievable, in essence. Okay, possible to attain, relevant and recorded at all times. And lastly, they must be time bound. Okay, basically give yourself a timeline to have the goal achieved by. Okay, a deadline. Write them down. Writing them down almost serves you with a plan. In order to develop your own successful trading plan, you could focus on the four following core key components of risk and money management: methodology, trading rules, and journaling. Risk and money management deals with your risk appetite, okay, in order to make a calculated profit or calculated loss, and how you will manage risk. For example, your stop loss and take profit. The rules are, in a few words, your entry rules, okay, your trading strategy. The methodology is your trading system and strategy. To differentiate between the two, okay, a trading system is all the tools that you use together, such as your platform, indicators, time frames, calculators, whereas the trading strategy is pretty much a set of rules to follow to enter and sometimes exit trades. Okay. By methodology, I mean the use of the tools and rules to execute a trade. Finally, journaling is your recording of every action that you take towards trades, your goals, your strategy, and others that could help develop a trader's mindset. Okay, now let's look at those a little bit closer. Risk and money management, to me, is all about preserving your capital. A trader must decide on the available risk capital to invest, okay, and the required capital, which is the minimum required to have in your account in order to trade your strategy. Risk per trade is what you're willing to risk for an individual trade, and can be either calculated in percentage or pips or money. This is basically your stop loss or your exit, okay? The maximum drawdown is the most you have set as a limit to lose before stopping to trade, either for the day or until you improve your strategy, okay? Exposure is the total amount or risk percentage you're willing to risk while you're holding open trades, and profits simply deals with what you do with your profits. Rules. A trader can create rules on goals, risk, trade preparation, exit and entry, and recording his activities. For me, goals are tied to the risk-to-reward ratio you are willing to accept. Okay, we talked about the SMART method earlier. What is a reasonable gain you're looking to make a month? Break it down in what you have to make per day or per trade. Then look at what you're prepared to risk per trade, and there you have your risk-reward ratio. Next is find the opportunities that fit your requirements. When this happens, it's good to have a process to follow before executing. One can prepare by having a sound alarm for entry signals, one by visual signals, for example, breaking a resistance or a support level. One wants naked charts. Someone else may want to have a couple of indicators on. Up to you, but set the rule. The general sense is that your charts must be easy to read. Okay. Next on rules, your exit and entry rules. And the exit is there first because it's much more important than your entry. Your exit is risk management. A trader could calculate a stop loss and a take profit simply on the charts by counting pips from the entry. Your entry is your strategy rules. Okay, for example, when 1, 2, 3, 4, 5 occur, then a signal is generated and a trade could be opened. Finally, the last set of rules apply to recording information, such as why a trade was lost, why you decided to close a trade earlier, and if this was the correct thing to do. Okay, how did it make you feel? Just to name a few. Next key component I found important, methodology. It's made of 4 elements: the trading system, the instruments to trade, the time frames to use, and the entry and exit signals. The trading system really depends on your trading style. Okay, what time of market you like to trade, what hours you feel more comfortable trading. Okay, instruments are simply financial instruments you find more suitable to trade. Do you think stocks are risky? Then probably currencies could fit your style better. Okay. Expert traders trade a combination of instruments just to diversify risk. Okay, you could also design your own portfolio strategy. Time frames. Time frames determine the market data you can work with to build the strategy and trade. Experts look at different ones when analyzing the markets to find confluence. Okay. Finally, the last elements of the methodology are the entry and exit signals, pretty much your trading strategy and the rules for risk management. Last on the core key components to creating a plan is journaling. According to experts, journaling is the best tool to develop a trader's mindset, okay, by keeping records of all the activity and emotions before, during, and after the trades. Okay, this is how you measure your performance and how you identify where you could improve. Few examples of what you could record are your daily profit and loss, your ability to follow your plan, your mistakes, and your feelings when you go back in time and recall the situation, okay? The facts you remember during the time you made a mistake and what you could have done different or even better, okay? What you can do next time in order to avoid doing the same mistake again. Also, you could record your feelings knowing that you have to achieve a better profit tomorrow due to the mistake you did today. Okay, that will help you control your emotions better. There are other things you could include, like how did you feel in the morning about the markets and that made you stay out for the day, for example. Okay, what did your research tell you? But this will come, of course, after becoming more experienced with the markets and more aware of your emotions. In general, changing to having a plan is there to help you. Okay, science also supports this logic. In this graph, you're looking at the 5 stages of grief. Okay, note that the model is not linked only to the subjects of death and dying, but it has over the years expanded, okay, to include any form of loss. And this is why I find it very relative and useful to understanding your trading psychology while you experience changes. Okay, so let's push a little further here. Stage 1, denial. Denial comes when you start believing that your analysis is wrong because you have bad experience with losses. Okay. However, you need to believe that you will get a good outcome or believe that your analysis is reasonably correct to execute a trade, for example. Okay. When you start realizing that you have to get out of the stage of denial and you'll become then you will become frustrated and angry. Okay, thinking that the situation you have brought yourself in isn't fair. Well, you will start looking for something to blame. Okay, and guess whose fault it is? Okay, it's always the market's fault. Anyhow, what is beneficial with the stage of anger is that in your search to find what really went wrong, you will be able to see the positives and bring a bargain on the table. Okay, something like if I don't execute the trade because I'm unsure, then I won't be obviously risking any money. But then you will think, despite this compromise you have just created for yourself, okay, if you don't execute the trade, there is no way you will realize any profits. Knowing there's nothing else you can do, you will start feeling guilty and end up getting into the stage of depression. Here you will feel stressed and sad as you will feel unable to cope with the situation and start realizing that maybe if you accept the situation, this will help you move past the emotional pressure of the stress and sadness. Whereas you will probably have decided not to do anything about the trade. Okay, this is the emotional trip traders go through when missing trading opportunities. For example, obviously my argument here is that when you have a plan, this is probably going to fade away as you will become more competent, okay, while you go through this change. All traders have gone through change and they have reached the stage of unconscious competence. They are called experts. Here we see the 5 stages of change a trader experiences to become an expert. Stage 1 is the unconscious incompetence. It's what I like to link with beginner's luck. Okay, this stage is the starting stage into trading, and since you have no experience or knowledge of the markets, okay, the only way to make gains is only if you're lucky. Okay, now this stage doesn't normally last for long, okay, as one shouldn't take long to understand that more work than just clicking a mouse is required. Okay, this is where a beginner moves to the next stage of conscious incompetence. This one I like to link with loss of confidence and money, as a trader knows now how much work is required. Okay, so conscious, he or she goes and tries all systems and indicators there are, believing that he will find the holy grail. Okay, and what's the result? Loss of money and confidence. Stage 3 is the most important stage for me. Okay, it's the stage of revelation as you start becoming a trader of your own. After having worked on all those indicators and systems, and now you're more knowledgeable about the markets and you can create your own system and strategy. Okay, setting some rules to follow, even if not written yet, which could potentially lead to a break-even scenario. as long, of course, as you keep learning from your mistakes. Okay, you now forget about status and start thinking carefully where you want to go with this. Next up is writing your strategy rules down, developing a plan as you now become conscious that you are making generally good trades and should start recording what makes more gains or losses for you. Okay, you now accept losses as wins, knowing that you only trade when your plan tells you to, and realizing that no strategy will work 100% for you. Okay, but rather it could bring consistent weeks that you're doing well. Okay, this stage should last for about 6 months to a year. Okay, depending on the time you dedicate, of course, as well, while you are slowly mastering your emotions. Okay, you are basically operating your own manual here and not your own good sense. Okay, I will repeat this. You are operating your own manual and not your own good sense. This will give you the ability to follow your plan to the point and allow you to grow your account, and hopefully your could also allow you to grow your gains. When you reach stage 5, you will only be entering big winners, okay? Winners that give you the reward you have written on your plan, and risking only the percentage you have allowed yourself to risk per trade so that your goals are achieved, okay? Now, at this stage, you are an expert trader on autopilot. Now, this is where you can tell yourself, I am a Forex trader. You are now able to look back at this trip and laugh at how the get-rich-quick mindset you had when you first started become rich slowly. It takes time and effort, okay? It's not easy, and that's why not many people make it, okay? Unfortunately, statistically speaking, only 5% of you will make it. Okay, here's something for you to take. 19 traders out of 20 fail to change. It's not the strategy, it's not the rules, it's not the market's fault, okay? It's you, clearly. Willing to change will make you realize that testing out 20 different strategies will not bring you the one that works, okay? And that is you that should change. So stop changing strategies, get to start in the markets, make a plan and follow to the point, okay? I want to close this off with some nice statistics I'd like to share with you here today. As mentioned just seconds ago, only 5% make it through, okay? Trading is not a game, but it could become your game when you set your rules. All games have rules, okay? If you make rules, a plan, and consistently follow it patiently, then the chances are that after 2 years you could be still in the game, okay? Don't worry if you don't make much gains. As I explained closer to the beginning of this webinar, traders should concentrate on the process and not the results, okay? But I want you to know that you will not realize profits quick unless if it's just beginner's luck, okay? And you will only be able to make large profits consistently if you become an expert, okay? Statistics also show that men trade more than women, while those that are not married are more likely to get their hands on trading. So if you're single or not married here, research says that you're more likely to not give up anytime soon. Nevertheless, if you start gambling, it's probably not going to last long either. So please be very careful how you approach the markets and how you approach this, okay? Enrolling. Now, if this was any helpful to you and you decide to follow through a few of the points made here, you could end up controlling your emotions better, okay? So holding losses longer or overtrading could have been proper for you, as it has been for others, okay? Note that the intelligent investor will do anything possible to reduce risk and increase profits, okay, in a systematic approach. And one that had worked for most is risk diversification. Okay, and lastly, a staggering number exposing the gambling problem in Taiwan. 2% of the country's GDP comes from lost investment. I don't know the exact type of losses, whether it's casino, roulette, online trading, but this percentage is big. Okay, the time has come up now. If you have any question, please make sure to send them on my email, which is mentioned in the first page of. Okay, the time has come up. If you have any questions, okay, please feel free to send me an email at my email address displayed on the slides. Okay. Thank you everyone for watching. I hope you enjoyed it as much as I did. Okay. Keep an eye on our website for our next educational webinars. And as I said earlier, if you have any questions, feel free to email me with your questions. Okay. And just have a title webinar questions. Thank you and have a good day.